Welcome to the Deep Dive. This is Talk Tickers, and today we're digging into the Kroger Co.'s Q2 2025 earnings call. That happened back on September 11th.
Right, and our job here is really to cut through all the details and give you the operational shifts, the profit story, and the guidance that actually matters for the rest of their year.
So what's the headline? If you had to sum up the quarter quickly.
I'd say it's competent execution, definitely a beat and raise quarter, lots of self-help driving things.
Okay, beat and raise sounds good.
It is, but the market reaction was, well, pretty muted. It just confirms that the bar for these staples retailers, it's incredibly high right now.
Interesting. Let's jump straight into those numbers then. Give us the snapshot. What were the main results?
Okay, bottom line first. Adjusted earnings per share, $1.04.
Yeah.
That solidly beat the street consensus, which was around 99.
So about a 5-6% beat. Pretty decent.
Yeah, very decent. But the top line, revenue, was a bit softer. Came in at $33.94 billion. Consensus was closer to $34.1 billion.
Okay, so a slight miss there. Revenue basically flat year over year.
Roughly flat, exactly. So great profitability, but growth was more, stable. Tells you a lot about cost control.
And operational momentum. Did we see that somewhere else?
We absolutely did. Identical sales, if you exclude fuel, they grew by a solid 3.4% year over year.
Okay, 3.4%.
And the key thing here, this is the sixth straight quarter they've improved identical sales. Sixth.
Wow. So that's not just a blip. That's sustained performance in the core grocery business.
Exactly. Not some, pandemic hangover effect. Real consistent strength. But even with that, the stock, well, it only closed up about 0.3%.
Only 0.3% after a beat and raise and that kind of comp growth.
Yeah, it tells you expectations were sky high. Seems the beat was largely priced in. So the company really had to show, look, our internal efficiency stuff is working.
Okay, let's unpack those internal strategies then. Because that EPS beat, it points straight to margins, right? The reported gross margin rate, up 39 basis points year over year, hit 22.5%.
It did. Sounds great on the surface. But there's a big asterisk there.
Okay. What's the catch?
Well, that 39 basis point jump, a lot of that, maybe most of it, came from selling off their specialty pharmacy business.
Right, I remember that divestiture, lower margin business.
Exactly. So when you shed lower margin revenue, your overall rate automatically looks better. It's structural, not purely operational improvement in the core stores.
Got it. So we need to adjust for that. What did the core grocery margin actually do, excluding that pharmacy effect?
Okay, so if we look at the FIFO gross margin rate, FIFO is just first in, first out, how they track inventory cost.
Right, important in inflationary times.
Very important. Even with FIFO, which can kind of inflate margins temporarily, the core FIFO rate actually decreased, but only by 9 basis points.
Only 9? Wait, a decrease? Why is that considered good?
Because think about it, they were hammering prices this quarter, lowered prices on over 3,500 more items, really trying to look sharper against competitors.
Okay, massive price index.
Massive. So to invest that much in price and still keep the core margin basically flat, I mean, a 9 basis point dip is less than 0.1%. That shows incredible control.
Control over costs, sourcing.
Both. Phenomenal control. And that control, that's what drove the adjusted FIFO operating profit up to $1.091 billion. That's almost an 11% jump year over year.
Okay, an 11% jump in operating profit. That takes some serious cost discipline somewhere else then. Where did they find those savings?
That takes us straight to OG&A, operating, general, and administrative costs. The rate there dropped 41 basis points on an underlying basis.
41 basis points is huge in retail.
It's huge. And this wasn't just, trimming paper clips. This was driven by a big corporate overhaul. They reduced the corporate admin team by nearly 1,000 people.
1,000 associates.
Yeah.
Wow, that's a significant move.
Significant and probably painful. But these are the kinds of non-recurring actions that create lasting structural efficiency. Shows how serious they are.
Yeah, no kidding. But cutting that deep, is there a risk it impacts morale or maybe even slows down execution elsewhere? Can you cut too much?
It's always a risk, a fair point. Management would say, look, these were calculated moves, targeting redundancy, getting resources closer to the customer. And, well, that 11% operating profit jump suggests the efficiency gains are winning out, at least for now. They're putting the savings back into the customer experience.
Okay, let's talk about that customer experience. They mentioned this dual strategy. Investing in price for the value folks, but also keeping the premium shoppers happy. How are they actually doing that on the ground?
It's pretty detailed. For the value segment, they're using simpler promotions. And interestingly, they brought back paper coupons.
Paper coupons? Really? In 2025? Seems a bit retro.
It does. But it's a direct play for customers who aren't using the digital app, maybe older folks, and definitely the low and middle income households who are really feeling inflation.
But isn't that inefficient? Printing, distribution, doesn't that counteract the digital savings? Or is that segment just that important?
They seem confident it's worth it. The data apparently shows those lower and middle income shoppers are responding. They're coming in more often, buying smaller baskets, and really leaning into the private label stuff like the basic Kroger brand. So volume win.
Okay, makes sense. And the other end, the higher income households.
They're driving growth in the premium private brands. Think Simple Truth, Private Selection. So Kroger's managing the mix really well, catching the value hunter and the person willing to spend a bit more for quality, all under their roof.
And category-wise, where is the strength?
Led by fresh, e-commerce definitely, and pharmacy was strong too. Good core prescription growth, plus the boost from GLP-1 drugs.
Okay, let's pivot to digital then. E-commerce sales up 16% year over year. You said that was a leader. What's the big story there?
The really big shift this quarter? For the first time ever, delivery sales were higher than store pickup sales.
Delivery beat pickup. Wow. That signals a change in focus, doesn't it?
Absolutely. It reflects their push for speed and using their stores. They said 97% of their stores can now do delivery in under 2 hours.
97%, under 2 hours. That basically turns every store into a local distribution hub.
That's exactly the idea. It's a massive advantage, using existing real estate instead of building expensive, dedicated fulfillment centers from scratch. Lowers the last mile costs significantly.
So less capital needed compared to pure play e-commerce guys?
Way less. And it ties into their automated fulfillment network, KAFN. They mentioned they're doing an ongoing strategic review of KFN, trying to make it more profitable. We should hear more about that in Q3. Getting KAM right is key for long-term digital profits.
And making all this work, the 2-hour delivery, the pricing, the cost savings that relies heavily on tech, right? They mentioned AI.
Yeah, AI is becoming really central. They're using it in like 3 key ways. 1, competitive pricing, making sure they're priced right against local rivals almost in real time.
Smart.
2, and this is a big one for profit, AI for reducing shrink. Loss from theft, damage, stuff going out of date. AI helps optimize inventory, manage the cold chain better. That drops straight to the bottom line.
Makes sense. Less waste, more profit. And the third?
Faster fulfillment. AI helps coordinate things to actually hit that 2-hour delivery or pickup window. It's a real efficiency driver, not just talk.
Okay, so strong execution, structural cost improvements, that naturally leads to a better outlook. Let's talk guidance. What did they raise?
Yeah, the revised guidance shows they're feeling pretty good. They tightened and raised the range for comps, excluding fuel, now expecting 2.7% to 3.4% growth for the year.
Okay, higher floor, tighter range. Good sign.
And crucially, they raised the floor for the adjusted EPS range, now looking at $4.70 to $4.80 for the full fiscal year.
Raising the EPS floor is definitely a strong signal. But didn't they also kind of caution that the second half comparisons get tougher?
They did. The first half had easier comps year over year, so the back half needs continued sharp execution. The goal, they said, is for that underlying FIFO gross margin rate to be roughly flat for the whole year.
So they have to keep balancing those price investments against the cost savings and efficiency gains we talked about, like the AI shrink reduction.
Exactly. It's a balancing act. But their balance sheet gives them a ton of flexibility to manage that.
Right. The debt ratio looked incredibly low.
It's exceptionally low.
Yeah.
Net total debt to adjusted EBITDA is 1.63. Their target range is way higher, like 2.3 to 2.5.
So 1.63 is very conservative, lots of financial firepower.
Huge firepower. Lets them easily self-fund growth, buy back stock, raise dividends, whatever they need.
And speaking of shareholder returns.
Oh, yeah. They boosted the quarterly dividend by 9%. That's the 19th year in a row they've increased it. Consistent commitment there.
19 years. Wow. And the buyback.
The big $5 billion accelerated share repurchase, the ASR, that should wrap up in Q3 this fiscal year. And ASR sends a quick, strong signal of confidence, boosts EPS fast.
So lots of cash going back to shareholders. What about investing in physical growth? Are they pulling back or pushing forward?
Definitely pushing forward. Playing offense, not defense. They're closing some unprofitable stores, sure, but they're planning to accelerate new store openings by 30% in 2026.
Accelerate by 30%. That's aggressive. Signals they see good returns ahead.
Very strong signal. They think they can leverage that leaner cost structure in new high-return locations.
Okay, just quickly, any major worries? Macro risks. Tariffs seem to be on everyone's mind.
Management downplayed tariffs. Said minimal impact expected for a mostly domestic food retailer. Their stance is still, Raising prices is the absolute last resort.
And the failed Albertsons merger. Any lingering issues there?
Yeah, there's still some legal shadows, antitrust stuff, litigation around some divestitures they planned. It's more of a background risk, probably influences sentiment a bit, maybe limits some moves regionally, but it's not seen as a near-term earnings driver.
Okay, so despite all this good execution, the stock's reaction was muted, you said, down about 10% from its recent high back in August.
Right, which tells you the market is demanding near-perfect execution and maybe still discounting them a bit. Which brings us nicely to our final segment.
All right, this is the part we call This Is Not Financial Advice, just a thought experiment based on what we've discussed. Always talk to a pro before making investment decisions, but based purely on this deep dive. Got a wild yet plausible trade idea for us.
Okay, here it is. The thesis. Kroger's structural improvements in financial strength are being overlooked because the market's fixated on competitor noise or macro fears. So the idea is go long Kroger.
Long Kroger, why now?
Because that low debt ratio, 1.63, the strong cash flow, and all these internal self-help levers, the sourcing improvements, the AI for shrink, the new store plan, they offer a clear path to growth that isn't maybe fully appreciated. It's discounted potential.
Okay, so you see hidden value waiting for a trigger. What kind of trade structure captures that?
It's about betting on that internal execution. The stock's lagging that $74.90 all-time high from August. So maybe a call option spread. You're betting that specific milestones will force the market to notice.
What milestones?
Two big ones. First, proving the 2026 store acceleration plan is actually working and profitable. Second, that Q3 update on the e-commerce strategy, KAFN, showing that the store's fulfillment model is really paying off.
A call spread. How do you make it more interesting? Maybe fund it.
You could potentially fund part of that long Kroger position by selling a call option on a competitor. Maybe one that's growing fast, but has thinner margins, higher valuation, more reliant on, external factors than Kroger's internal discipline.
So leveraging Kroger's cost control against maybe a more capital-hungry rival, betting Kroger's self-funding power wins out in valuation.
Exactly. You're betting that Kroger closes that valuation gap through its own steady execution.
That's definitely aggressive, but it lines up with the story. Management taking clear steps to boost profit while still investing in price for the customer.
The beauty is it relies on their execution, things they largely control, not just hoping the whole market lifts.
Okay, so to wrap up this deep dive, Kroger's running a smart playbook. Value for customers through price investment, upgrading the mix with premium private labels, all backed by some serious internal work cost cuts, AI getting more efficient.
Yeah, and somehow they kept core margins almost flat, despite pouring money into lower prices. That's the key takeaway on execution.
Which leaves us with that final provocative thought for you, the listener.
Right. Management's committed to boosting new store openings by 30% in 2026. They also talked about sourcing optimization being this enormous opportunity they haven't even fully tapped yet. So the question is, how much more profit power is really hiding just beyond their current guidance? What's the upside they aren't quite promising yet?
That is the multi-billion-dollar question, isn't it? This has been a deep dive into the Kroger Q2 2025 earnings call. Let us know your thoughts or any follow-up questions you have.